Hey everyone, welcome back to Corporate Decoder. Today, MSA Safety Incorporated just dropped their quarterly report at 10Q, and I am seeing some interesting trends in their sales and how they're managing costs. Quick note, this is not financial advice, just my take on public filings for educational purposes. The big takeaway is that while sales are growing, the company is really focusing on squeezing more profit out of every dollar sold, and they made a pretty significant acquisition that is starting to show up. Let's dive right into the numbers, specifically looking at their income statement for the 3 months ending the 30th of June 2026. Their net sales hit $503.3 million, which is a solid increase of about 6.2% compared to the same time last year. This growth is happening in both their Americas and international segments. The Americas segment saw a 6.7% jump, bringing in $341.4 million, while the international segment grew by 5.1% to $161.9 million. This tells us their products are still in demand globally. Now, here is where it gets interesting. Their gross profit, that is the money left after they pay for the stuff they sold, jumped by almost 13% to $249.3 million. Even more impressive, their gross profit margin improved from 46.6% last year to 49.5% this year. This means they're not just selling more, they're keeping a bigger slice of the pie on each sale. Management credits this to strong pricing, better efficiency, and even some favorable currency movements and tariff refunds. On the cost side, their selling, general, and administrative expenses, which are things like marketing, salaries, and office costs, went up slightly to $114.1 million. But importantly, as a percentage of sales, these costs actually went down from 23.6% to 22.7%. This shows they're managing their overhead well, even with adding expenses from a recent acquisition. They also increased their spending on research and development, which is good to see for a tech company. It went from $17 million to $19.2 million, showing they're investing in the future, with a focus on software and connected safety systems. They did have some restructuring charges of $2.2 million, mainly related to optimizing their operations and workforce in response to economic conditions, which is a common theme we see across companies right now. Currency exchange losses were lower this year at $1.9 million, down from $5.3 million, which is a positive sign for their international business. All of this combined led to a significant jump in operating income, up to $112 million from $85.9 million a year ago. That's a nearly 30% increase. Looking at the balance sheet as of the 30th of June 2026, their total assets are now $2.6 billion. Their cash and cash equivalents also saw a healthy increase. And a quick check on their stock. They have over 38 million shares outstanding. Now, the bottom line, net income, for the 3 months ended the 30th of June 2026, it was $86.2 million, a big jump from $62.8 million in the same period last year. This translates to earnings per S-share of $2.23, up from $1.59 last year. If we look at the first 6 months of the year, the trend continues. Net sales are up 8% to $967 million, and net income is up about 30% to $157.5 million. Their gross profit margin also improved year over year for the 6-month period. A big part of their strategy has been acquisitions, and they finalized one in May 2025 for a company called M.I.C. This deal, valued at about $189 million, brought in new gas analysis systems and is now contributing to their sales and earnings, showing up in both their Americas and international segments. Management is already working on integrating this acquisition and realizing its full potential. One area that stands out is their pension and post-retirement benefit costs. They actually have a net pension income, meaning the returns on their pension plan assets are contributing positively to their income statement, which is a nice tailwind. They do mention product liability, which is standard for manufacturers, especially in safety equipment. They have reserves for potential claims. And importantly, for some legacy issues related to a divested subsidiary, they have strong indemnification agreements in place, which should protect them from significant financial impact. They also highlight ongoing litigation related to PFAs in firefighter gear. This is a developing area and they're defending these claims vigorously, also pursuing insurance coverage. It is definitely something to keep an eye on, but it sounds like they have a solid strategy to manage it. Looking at the management's discussion, they are confident about their future growth, expecting mid-single digit organic sales growth for the year, supported by strategic pricing and a strong backlog of orders. They're also looking at acquisitions to fuel further growth. Overall, MSA Safety Incorporated appears to be in a strong position. They're growing sales, improving profitability through efficiency and smart pricing, and successfully integrating acquisitions. The key risks seem to be managed, like the PFA's litigation with indemnification and ongoing defense. Their continued investment in technology and safety solutions suggests a forward-looking strategy. What I'll be watching closely is how their organic growth holds up in the international segment, especially with global economic uncertainties, and if they can continue to expand their high-margin products. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.